Hi, my name is Sean Davies, and I'm a finance professor at the University of Colorado Boulder. Go Buffs. In today's Things That Are Important but Incredibly Underappreciated, we're going to talk about short squeezes. Now, you may have heard the term short squeeze discussed a lot back in early 2021 with the advent of Wall Street bets, things like GameStop and AMC. It was a crazy time, and we saw massive amounts of short squeezes in markets. And we've seen some murmurs about short squeezes recently. And so, for those of you that aren't particularly well versed in what a short squeeze is, I'm going to use this video to just provide sort of context with what a short squeeze is and how it occurs. But we have to understand some guiding economic principles. But to motivate things, I'm going to go ahead and share my screen. And what you're going to see here is an article today, from yesterday, from the street, wondering if we were going to see a short squeeze in AMC stock, the movie theater company. And that's because AMC has these things called preferred equity units, sometimes referred to as APEs. And these preferred equity units in a capital structure, and I invite you to watch my video on balance sheets if you're unsure with capital structure and what a liability is. But preferred equity is senior to common equity, meaning that as a firm incurs losses, the common equity gets hit first and then the preferred equity. So the preferred equity is a little bit safer than the common equity. And the preferred equity oftentimes has other features with it, like a preferred dividend and certain conversion and callable features. But these preferred equity units for AMC are converting into common equity this Friday, which is causing some concern about something called dilution. More shares, more equity out there chasing the same amount of firm value. And so short sellers, and we'll talk about these, are making bets that the value of AMC stock is going to go down. And what we're seeing is massive, what we call short interest, a massive volume of people taking a short position on AMC stock. Given that there is such strong short interest, there's concerns of a short squeeze. And that's what we're going to jump into and talk about. So, to provide some guiding principles of what this is, we need to sort of understand what short selling is. So, let's start with what short selling is not. So, if you are long a stock, okay, meaning you own it, you desire that the price of the stock is going to increase. You're bullish if you are long a stock because you think it's going to do well. So, a natural question then is, not everyone has positive views or bullish views on stocks. Sometimes you have a negative view and you think something's going to go down in value. So, how does one express a negative or bearish view on a stock? Well, one of the most common ways is short selling. And we're going to talk about the details of it. But another way is to buy put options, which I talk about in a different video, and you can find the link below. But let's focus on short selling. And so the mechanism of short selling is the following. You must first establish a margin account with a broker, and you're going to post a certain amount of collateral, dollars, and how much that margin is going to be determined by regulations, things like Regulation T, as well as the broker is going to have some different rules and regulations based on market conditions and different factors like that. But the actual short selling process sounds complicated, but it's not that bad. You borrow shares you do not own, and then you go to the market and you sell them. So you receive a cash flow when you sell those shares. Then you're hoping that in the future, the value of the shares declines, so you can go back to the market, repurchase the shares, and give them back to whoever you borrowed them from. Okay, so the idea here is you're selling at a high price today, and you're buying at a lower price in the future, and you're trying to capture the difference between those. And so that's how you can take a bearish or negative view on a stock, is through short selling. And so a natural question is, are the risks associated with being long, outright owning a share of stock, versus being short, where you borrow shares, sell them with the hope of rebuying them in the future at a lower price, are the risks due to market movements in that stock the same? Well, let's start by thinking about it from a long position. So suppose I buy a share of stock and it costs $10. Well, what's my potential downside? Well, the stock could go to zero if the firm goes bankrupt, for example. And so my downside is limited to just my initial investment, $10. I bought a share for $10, and the lowest it can possibly go is zero. And that's because stock prices cannot go negative. Once you hit zero, that's the bottom. However, if I'm long a stock and it starts doing well, I have unlimited upside. Just go back to the early 1980s and look at what Apple was trading at in the 1980s and compare it to today. The upside is unlimited when you're long a share of stock. Now let's take it the other way and think about being short a share of stock. So if I short a share of stock, my potential downside is now unlimited. My upside is $10, right? If the shares plummet in value, well, the most they could plummet to is zero. I sold them for 10 when I shorted them, and I go back to the market and buy them for zero and cover my short position. So at most I can make $10. That said, since I am short, if the stock price continues to go up, I'm going to have to rebuy in the future at a higher price, and I've now lost money. So my downside is unlimited. Okay, so very different than being long. And so there's certain risks associated with short selling that aren't there with being long. So if a stock price goes up, okay, the value of the short position goes down. And so what are you going to do if you short sold and all of a sudden the stock price starts going up? Well, you're going to be very nervous. And so short sellers may choose to limit the damage by reducing or closing their position, okay, incurring a loss, right, going to the market, buying shares, bringing them back and covering their short position. Alternatively, okay, a short seller may not have a choice. Okay, the broker may issue a margin call, meaning you need to post more collateral, more margin, in which case maybe you have to close some of your short position just to be able to get your account in the right position. But if you're not able to make the margin call, well, your broker's going to close the position. They're going to go buy the shares in the market to cover your short position and then take those losses from your margin account. And what else is going on here is if we go back to some videos we made about options, if people had bought put options, which is another way of expressing a negative point of view or a bearish perspective, the delta of those put options is becoming less negative, meaning whoever is the market maker in those put options is buying stock back. And so the combination of short sellers covering their short positions and market makers unwinding their delta hedge on puts that they're short, which again is in a different video. Together, collectively, what that means is that covering short positions and unwinding delta hedges of put options in up markets, you're buying more shares to cover your short position, which means prices can go up. And so what that can do is that can lead to a positive feedback loop that leads to more covering of shorts, and we can get into this sort of cascading effect, which is known as a short squeeze. And so that's why people get nervous when they short, is because they could get squeezed where they have to cover their short position. So a lot of people yesterday were concerned that given the tremendous amount of short interest in AMC, that we would see market participants start trying to put some pressure on those short sellers, bid up the prices, cause them to cover, and see just a massive exponential spike in the price. And so a natural question is, did we see that in Monday's trading? Let's just go back real quickly and see how AMC did on Monday. So we'll go over to an article from Barron's. Turns out the short sellers had a good day on Monday. Okay, AMC stock tumbled 24% on Monday. And so the short squeeze did not occur despite a forecast for one possibly occurring. So that's that for that video. Hopefully now you understand short squeezes and why they are dangerous for short sellers and can cause excessive market volatility, particularly to the upside.